Over the past 3.5 years, the performance of the JSE and other emerging markets have outperformed the performance of listed African equities by a wide margin. Now, the widening of this gap has led some portfolio managers like Sustainable Capital to suggest that investors could profit as the performance of both markets revert to the mean. Greg Barker joining us from our Cape Town studios to explain the concept of sustainable investing, and of course, Greg from Sustainable Capital. Greg, thanks so much for joining us. So let's first take a look at the performance of African markets versus emerging markets, because, you know, Africa, ex-South Africa in dollar terms, delivering 25% return since the beginning of 2009. South Africa delivering 110% return there. And then, of course, emerging markets as a whole, 95% return. To what extent is this currency related, and how would you explain this underperformance?
Yeah, well, I mean, basically, if you look at from when markets reset after the pullback in 2008, as you correctly point out, Africa, ex-South Africa listed equity markets haven't caught up with the emerging market peers, and also with the South African equity market, which has run, you know, over 100%, with the emerging markets at a similar level. So effectively, the differential, and that's why we titled the article "Mind the Gap," has widened quite considerably. But what's more interesting than that is that it's not really in touch with the fundamentals of the companies that we are seeing on the ground in Africa, outside of South Africa, on a day-to-day basis. So essentially, you're looking at the position now in Africa, excluding South Africa, where you're talking about, you know, big companies, high quality, but flying beneath the radar screen at very attractive valuation levels that are growing their earnings on average, say, 30 to 40% year on year. Yet the share price performance has not been commensurate with that. So the whole conclusion of our analysis is that on a mean reversion basis, to close the gap to emerging markets, Africa, ex-South Africa, needs to re-rate by 40%, and to South Africa, the number's closer to 18%, and that's in total returns in US dollar terms.
Mm-hmm. So, Greg, just to get this right, I mean, this surprises me quite a bit, because we hear so much more about Africa than we did 6 years ago, in my opinion, about the potential for the continent and the companies that are operating on the continent. And yet we still see that these share prices are lagging behind what you're seeing on the ground. So, you know, any idea why that's so? Is it perhaps a factor of liquidity in the African markets that's preventing these shares from catching up with the fundamentals?
To be honest, Warren, we don't try to spend a lot of time trying to understand why share prices have moved to where they are. Because our starting point is basically that the market price of the company is wrong, and we try to take it from there and just work out what the fair value of the company is, and where there's a big deviation in terms of the market price from the fair value of the company. In other words, it's trading at a wide discount, say 50% to its fair value. That's where we would tend to take a material overweight position. In terms of your question on liquidity, I don't think that's the case. I mean, if you look, for example, in our Africa Sustainability Fund, the portfolio weighted average market cap, in other words, the average size of the company by market cap in our portfolio is $6 billion US. So you're not talking about small companies here in terms of the listed equity market. Yeah. But one thing that I would point out is that in terms of imperfect information, Africa outside of South Africa is probably a lot more opportunities to generate stock-specific alpha, because you do have a much higher percentage, for example, of retail investors. For example, if you look at the big African markets like Nigeria, Kenya, Morocco, Egypt, they often more than 50% of the market volumes, or in some cases over 70–80%, are driven by retail investors. And what happens with retail investors is that in your bull markets, they get a lot more irrationally exuberant, perhaps, and then when things are going badly, especially because they're living in those countries, they get a lot more gloomy about the short-term picture. And effectively, that short-term sentiment is driving share prices miles away from their fundamentals. Whereas if you compare that to the situation in say, South Africa or other emerging markets, share prices are driven by a lot more by institutional investors that represent, let's say, over 80–90% of the market volumes that go through on the listed equity side.
Of course, Greg, no mistake that, of course, you're called sustainable capital. You employ the concept of sustainable investing, looking at environmental, social and governance factors. How tricky is it to do this in Africa right now? Because as you say, there's that information issue, there's corporate governance factors. Africa is still catching up to the rest of the world. So talk to us about that, and then talk to us about the type of companies that you have got a large position on based on these factors.
Yeah, I think on the contrary to saying that it's difficult to do sustainable investment in Africa, I think the opportunities there are even greater than in other markets, because what you have is you have a very wide divergence in the quality of the companies. And when I say quality, I'm talking including long-term factors like corporate governance, environmental liabilities, social factors like labor practices, from extremely high quality companies that are ahead of best international practice, absolutely cutting edge, to, on the other side of the scale, almost a sort of state-owned company culture, which is quite backward. But what's interesting is that in many cases, those long-term investment factors, which ultimately drive financial performance and shareholder value, are often mispriced in these African markets. So I would maintain that actually the opportunity to generate what we call sustainability alpha in Africa, outside of South Africa, is probably the greatest opportunity of any frontier or emerging market, because there's basically nobody on the ground doing that research on sustainability factors. And that's a lot of where we would add value as an investment manager, because we spend most of our time on the ground in those countries, actually checking the quality of the assets, going on site, meeting with management teams, and we integrate those long-term sustainability factors into our investment decision making and our portfolio construction.